Welcome to the Retirement Key, where we help you unlock the answers to your biggest retirement questions. My name is Casey, and I'm so excited today to be joined for the first time ever by Ryan Oliver, certified financial planner with Abich Financial Services. Ryan, welcome to the pod. How we feeling? Are we excited?
Yeah, thanks, Casey. Excited to be here. I appreciate it.
Good. I'm very excited to have you here and get your thoughts today. Quick reminder before we get into it, though, as you're listening, if you'd like to learn more or schedule a complimentary consultation with Ryan, you can visit us at theretirementkey.com. That's theretirementkey.com. It's got all the resources that you need to get connected with us. Now, Ryan, I love our topic today, and I think it's a great topic for your first episode because to me, it's like the warm, fuzzy part of retirement planning. We are going to chat about qualified charitable distributions, also known as QCDs. These can be a very powerful tool for retirees who want to give back while managing taxes. So let's start with the basics. Talk to us about what a qualified charitable distribution is exactly and how does it work?
Yeah, absolutely. So a qualified charitable distribution is a great way to get pre-tax funds out of a retirement savings account, like a traditional IRA, and into the hands of a 501c3 organization or a charitable organization you would like to support without any tax implications to the account owner or the charity. It's a really powerful planning tool and a great way to maximize tax efficiency for you and your family while getting the opportunity to see benefits of your dollars at work for a positive cause. Like you said, it's a warm, fuzzy part of retirement planning. It's what we like to do. And so, yeah, it's a really great tool.
So it's essentially a way to donate directly from your IRA to a charity without triggering taxable income, which is huge for retirees. But I want to talk about who can actually take advantage of this strategy. Who is eligible to make a QCD, and what are the age requirements here?
Yeah. So you have to be a traditional IRA owner who is at least 70 and 1/2 years old or older. It seems oddly specific,
Yes.
but the IRS is really specific about that. So if you turn, and as most people would, 70 and a half mid-year, the gift to the charity via the qualified charitable distribution actually has to happen later than that date within the year. But that's the age requirement, 70 and a half. Note that after recent legislation, it doesn't directly correspond with when required minimum distributions are. You can actually make those qualified charitable distributions as soon as 70 and a half.
Okay. All right. Well, that's good to know. Now, I want to clarify where QCDs can come from. What types of accounts allow QCDs, and are there any restrictions?
Yeah. So QCDs can be made from traditional IRAs, rollover IRAs, and inherited IRAs. But keep in mind, for those inherited IRAs, you still have to meet those age requirements that we just talked about in order to take that distribution and qualify it as a qualified charitable distribution. And you cannot make qualified charitable distributions from legacy 401ks or company retirement plans. You would be required to roll those over into an IRA first before you can follow the strategy. That's just one of many reasons why it often makes sense to simplify your life as you're approaching retirement. Move those qualified retirement plans into IRAs. Because it helps just keep organized and with investment allocation, but it also opens the door to different strategies like the qualified charitable distributions.
Got it. Okay. Now, you mentioned RMDs a few seconds ago, and one big question you have is how QCDs interact with RMDs. So can you talk to us about how QCDs can impact someone's required minimum distributions when it comes to their retirement planning?
Yeah, so it's in its simplest form, a qualified charitable distribution just offsets the required minimum distribution dollar for dollar. It's a really powerful impact. Many retirees will simply work charitable giving systematically into their cash flow because they've been doing it for years. And using these QCDs as a tool allows you to maintain those habits and directly reduce those otherwise inevitable taxable income, that is the RMD or required minimum distribution. So just as a basic example, say you have a required minimum distribution of $10,000 from an IRA and you wanted to do some charitable gifting to those organizations and you gifted $1,000. If you use qualified charitable distributions, you'll only be taxed on 9,000 of those $10,000. So on the slightly more technical side, though, the QCDs in place of your RMD also carries some attractive benefits because QCDs are above the line adjustment, meaning that it impacts your adjusted gross income. So the bottom line here is it almost never, especially for retirees that have reached that age, it almost never makes sense to do those gifts to charities, if you're giving them anyway, directly from a bank account. Utilizing the qualified charitable distribution or some other type of account almost always makes sense. So it's good to just talk with your advisor or someone that has a handle on your whole situation that can give you the best strategy there.
Yeah, so using a QCD can actually satisfy your RMD without adding taxable income. Is that what you're saying?
Absolutely. Yeah, it offsets it. And RMDs are kind of the boogeyman for a lot of people. There's always these questions. Are RMDs going to, cause me to draw down my account? How am I going to use those required minimum distributions in a tax efficient way? And for those people who are charitably inclined, it really, whether or not you're going to do those qualified charitable distributions can really impact other aspects of your plan as well. What you're doing leading up to RMD age, not just whether or not you do a QCD in the year you attain that 70 and a half age.
Well, that sounds like a win-win to me. Now, what about the tax benefits compared to regular charitable donations? You touched on this a second ago a little bit, but can you talk to us more about that?
Yeah, absolutely. So there's a lot. Tax law can be really complicated, around this, whether you itemize or take the standard deductions, and those lines in the sand are, constantly changing. But as I said, the qualified charitable distribution, when you do it, it's as simple as saying, like, look, this is pre-tax money that you've saved for years and years. You've put it into your retirement account, and deduct it from your paycheck. And any dollars that you give to charity come out completely tax-free. That means that any growth that was in that account is completely tax-free, and it's income that you would otherwise be hitting the front page of your 1040, impacting other things like, Medicare surcharges, your ability to claim other deductions or exemptions, so on and so forth. It's just taxable income that you would have been required to take that you are not required to take if you're going to use that strategy. So, it has both direct consequences in terms of your taxable income in that year and indirect consequences in terms of other things in your plan, other levers that it can impact if you use the qualified charitable distribution.
So even if you don't itemize deductions, you can still get a tax advantage.
Yes, absolutely. For those retirees that were not itemizing and gifting money out of your bank account, there is a chance, and not just a chance, but it's likely that you were not receiving the full power of that charitable contribution. Now, it doesn't mean it doesn't make sense to do. Obviously, it could still bring some joy, but it's not the most tax efficient way to get those dollars to the people that you care about.
Got it. All right. Well, now let me ask you this. Are there limits on how much you can give through a QCD each year? Do they put a limit on people for that?
Yeah. In 2025, the annual limit is $108,000 per year per individual. So that's $216,000 for a couple that's married filing jointly. But keep in mind, you would need to each have your own traditional IRA to do that full 216. So, if just one, it doesn't matter if you're married, if only one spouse has all of the pre-tax retirement assets, then you would be limited to the 108 for that one spouse's IRA. New legislation has gradually pushed back the RMD age that we were talking about to ages 73 and 75 for some taxpayers, but they kept the QCD eligibility date at that same date, 70 and a half. So, for most people, I'm not saying all, but for a lot of people that are hearing this, $108,000 is going to fully offset the RMDs that people have. Some people, who have a whole lot of money in pre-tax retirement accounts, it may not offset the whole thing, but that's the limit. You're at 108 is what you have to stick to, and it's adjusted for inflation, so that'll gradually increase each year.
Okay, so there's a cap, but it's still a very generous amount for most people, you'd say. Got it. All right, now before we wrap up, Ryan, we like to be proactive around here. So what steps should someone take to make sure that their QCD is processed correctly? We obviously want to go about this the right way.
Yeah. So to make a qualified charitable distribution, you have to ensure that those funds never pass through your hands. So the funds have to directly leave the IRA to the charity. That could either be processed by the custodian and a check directly to the charity. Other custodians will issue QCD checkbooks where you can actually physically write the check directly to the charity out of your IRA. But either way, it cannot hit your bank account before it goes to the charity in order to qualify. And one more thing to think about just logistically, we often recommend doing and coordinating these QCDs earlier in the year rather than later. So if you typically find yourself, gifting to charities monthly, maybe you pull up a couple of months so that you make your final, QCD in October, a little bit earlier in the year, or maybe you give in a couple of lump sums throughout the year instead. it's counterintuitive, but a lot of charities will actually take longer than you expect to cash checks. You'd think that they would be eager and quick to cash them, but sometimes it has processing time. And if that check doesn't clear your IRA before the end of the year, then it wouldn't qualify as a QCD. So logistically, you just want to make sure you never touch the dollars and just try to think a little more proactively about it during the year and gift earlier in the year rather than later.
I think clearly, too, if this is the route that you want to take, that it's really imperative to incorporate the help of a professional to kind of help you through this process, because you want to make sure you are going about it the right way. So,
Yeah.
Ryan, should listeners have questions that they want to schedule some time with you, what should they do if they want to get in touch?
Absolutely, yeah. Head on over to the retirementkey.com. You can get in touch with me or another financial professional, like me. We've got a lot of experience dealing with qualified charitable distributions and how it interacts with other strategies that you're implementing. So, yeah, always happy to chat about that.
Yes, you can head to theretirementkey.com to learn more and schedule a complimentary consultation. That is theretirementkey.com. Thank you so much for joining us as we broke down qualified charitable distributions for you today. We've got more great topics coming your way, so make sure you subscribe wherever you get your favorite podcasts so you never miss an episode with us, and we will see you next time. Ryan, thanks so much.
Yeah, thanks, Casey. I appreciate it.